All right, good morning, everyone. This is Jeffrey Cohen, coming to you live from Highland Park, Illinois, here to talk about the push to 1,856 assets. So, and I've got up on my slide a presentation document that we used with the Washington, D.C. quantum computing meetup last week. So I'll have some slides and things that we can share. But really important is we have been scaling up our models. So it started off, we had 40 stocks in our mindset, and we went for National Science Foundation funding. And we said, we're going to do 40 stocks because 40 stocks was over 1 trillion combinations. And we were going to learn how to use classical and quantum methods to do so. So what happened was, it took us forever, but we got 40 stocks to work. And it worked great on the quantum computer. And then we drove to 60 stocks. And that actually worked well. I mean, not perfect, but well. And then we figured out the maximum on D-Wave, the 2017 architecture Chimera, is 64 stocks. Now, if you're into science, it's 64 fully connected vertices or cliches. And so think of it as if you're doing a walk on a graph, right? It's every dot is connected to every other dot. And so that's a pretty connected graph. So you can have 65 of those. We round down to 64, and for the most part, I'd say about 80-85% of our quantum runs run successfully with between 60 and 64. And so, but that's not big enough to really stress any systems, right? So we can do 64 stocks in under a minute classically on my Macintosh. And so that doesn't feel like the right test. So a week ago, I'm going to pull up a Google Chrome window. A week ago, we did something else. We said, you know what? Let's run 314 stocks. And we did this, and not many people have read it, to be honest. But September 8th, we entered 314 common stocks into our portfolio optimization application. First off, I expected it to break. It did, but within one night, we were able to clear out all the errors, and we could run 314 stocks. So I'm giving you the background because actually we, over the past week, have been running, actually we ran it once, but we've been trying to run 1,856 stocks. So 1,856 stocks is every common stock listed on the New York Stock Exchange that is either not a test ticker and does not have accounting irregularities. And we get that data from NASDAQ. NASDAQ actually publishes on an FTP site all of the stock tickers, and we take away things like preferred stocks. We take away ETFs. We take away stocks with a negative beta. We take away stocks with just some other validation steps that we take. And so for 314 stocks, what happened? I'm not going to talk about all the concepts here, just to get right to the technical pieces. So the search space on 314 stocks is 3 times 10 to the 94th power, or this enormously big number. That's how many portfolios we check when we do 314 stocks. Now just imagine for a minute when we do 1,856 stocks. So there's a rule of roughly 3, a little less than 3. So 314 stocks, it's 94 power. So 1,856 stocks is probably like the 520th power. So we're looking to search a space that has, let's say, 10 to the 500th power. And we're successful. Worked. Yay, it worked. But of course, there's challenges, and so we're going to talk about some of that. Let's talk about the challenges to get to 314, and then I'm going to go through my notebook, and I'm going to talk to you about the challenges to get to 1800. By the way, real data analysts who scale for a living talk about 10,000 variables. We had a call on Friday with Meta Analytics. By the way, great firm out of University of Colorado, and just sharp people, men and women both. Terrific team at Meta Analytics, and they've actually got tools, solvers that they've written that they offer on Amazon, which work great. Meta Analytics talked about like 100,000 variables, so we're not quite at that level. But we're talking about stocks, and stocks have their own kind of their own models, right? And so, we did a Koleski decomposition, and in fact, we do end up with the same issue. When you have very, very many stocks, the Koleski decomposition makes sure, ultimately, that you will not have negative variances, because negative variances or complex variances don't exist. A variance is positive or it's zero. It can't be negative. It's just what it is, right? And so, but a Koleski decomposition is a very aggressive validation step. Really, all we need to do is make sure we have positive eigenvalues within some tolerance. And so the first thing we found was the level of precision of Python is not our friend. We were getting negative eigenvalues when they should have been zero. So 10 to the negative 18th, 10 to the negative 21st. So we work around that. Second is that anything where we say, hey, how many options are there, doesn't work anymore, right? All that kind of like a fancy formatting doesn't work, because Python can only show an integer value up to 10 to the 308th. Now, the guys were telling me there's ways to work around this, but honestly, I don't care. It's for formatting, get it out. So any of this like nice formatting, we have to pull out of the code. Focus on picking the right stocks. Don't focus on a lot of this other stuff. The printouts were failing because in matplotlib, because there were too many values to show. So we have to set a chunk size parameter to 10,000. That's anyone who works with Python knows that. And we had an issue, and actually we still do in our Monte Carlo runs, where a few of the portfolio sizes show up as having no valid random samples. And so it's a formatting fix. Honestly, it's not a big deal. But and the first results of our 314 asset run were that the genetic algorithm was best, followed by custom Monte Carlo, simulated annealers, and then the taboo sampler. So how many stocks were picked? This is where it gets interesting. A random sampler picked roughly half the number of stocks. And for your math wizards out there, that's about right. N over 2. If N is 314, you would expect 157 stocks to be the random best stock. But what was interesting was our simulated annealer picked 110. And our genetic algorithm picked 40. But our Monte Carlo, which favors, it's a fat tail, so it favors the smaller portfolios and the very large portfolios, picked 3. And our D-Wave simulated annealer picked 11. So what this tells us is if we have more time and we tune and we optimize our classical solvers, which we will if we're ever going to go production on 300 stocks, then we need to get the time to run down and we need to get the stocks selected and the Chicago Quantum Net scores to coalesce. But what's nice here is you see some different options showing up. Next steps. Scale to 3,200 stocks, which is the full set of New York Stock Exchange, which, to be honest, that number is about 1,900 to 2,000 stocks, but we apply validation. So we have to take out the test stocks, negative beta stocks, accounting irregularity stocks, and some other validations around like the score of beta. We have to do that, right? So we have a good the big thing we had to check is, did they all trade continuously and have data available on Yahoo Finance for 253 days? So we'll talk about one of the issues of that. We are also including 2 more classical methods in the challenge. One is Toshiba's simulated bifurcation machine, which currently runs on Amazon, and quantum walks on graphs, which we're coding all custom. And we did try again with the D-Wave hybrid solver, but it still hasn't worked for us. And so, a little bit of an advertisement. We offer to optimize your stock portfolio, and we have had customers already. For $50, we can use our classical models, which work great. Or for $150, we also ask the quantum computer, and we run quantum models for up to 60 stocks. So you tell us the stocks, up to 60 and 6 backup stocks. You pay us, we'll run it, and we'll run it in all the different models, and we'll give you the results in a custom written report just for you. So now let's talk a little bit about kind of bigger picture, 1,800 stocks. So I just want to take you back to the math that we're using, because for some people this may be the only video you watch. So we created a new way to pick stocks. So the old way to pick stocks is over here. It's called the Sharpe ratio. By the way, it's been in use for 70 years. It works fine, right? It says, take the profit you would expect from a portfolio and then divide it by the standard deviation or the square root of the risk. And then that gives you a ratio of how much profit for every unit of risk. The reason that they do standard deviation, and for those, most people don't even know what that is, it just gives you a percentage. So the top, the return, gives you a percentage. I'm going to earn 10%. And the standard deviation could be, and it's going to cost you 2.5% of risk. So it's a 4. Sounds great. 10 over 2.5 is 4, my Sharpe ratio, done. It's really hard to calculate, though, and it's affected by things like interest rates, inflation. These are normalized. These are normal rates of return. So if the stock market earned 10%, is that because the Fed printed money or bought stocks? I don't know. You don't know. Nobody knows. So this is very much kind of humanistic kind of a ratio, right? It's the weight of each stock times the beta of that stock, which is the basically the variance covariance of that one stock against the market. And we use for the market the S&P 500. Then it's the expectation, that's E, of the return of the market. So, hey, if you hold any stocks, you can earn, let's say, 10 or 12%, minus the risk-free return, which we use 13-week T-bills. We use 13-week T-bills because it's not that long. Like if you go to 2 years or 1 year, it's a long time, but 13 weeks seems like a nice short-term money holding. You multiply that up, and then you add back your risk-free return. So, because you're going to get the risk-free return anyway. So, and then you divide it by the standard deviation of your portfolio. A is the actual portfolio you're checking. So remember we talked about 3 times 10 to the 94th portfolios. If you want to solve this brute force, you have to calculate each one of those. That probably would take more than my lifetime. So we come over here to the right, and this is something we can calculate in a minute, on D-Wave in a second. And so what it is it's the Chicago Quantum Net Score. It's the variance of the portfolio. So there's no square root. It's just the variance of the weighted portfolio. So I still have to calculate it for 10 to the 94th power. But so if I have 10 stocks, it's the detailed calculation that takes the variance of that. And I subtract the expectation of the profit or the return of that weighted portfolio raised to a power. Now the power is 2 plus alpha. This power is a little bit of secret sauce because it depends on the overall returns of the market so that we can balance out variance and expected return. And so we do that. What else is interesting? Come on. There's got to be something else I want to tell you before we dive in. That's my cat, by the way. Just to show you the maybe the proofs in the pudding here a little bit. So for 60 stocks, we actually did our first portfolio where we went live, and we calculated it based on July 10th data. Now, we expect if we're basing our data on 1 year of historical data, that you're going to get 2 months to 3 months of predictive power. So that would be September 10, maybe latest October 10 for this portfolio to have any kind of legs or predictive power. So we took our ideal CQNS portfolio, which in this case was 2 stocks, Ameriprise and Apache. And over the first 5 weeks, it returned almost 14% return compared to all the stocks returning 7%. Now, we might have just gotten lucky. This is a research effort. We are not investment analysts. But you compare it to some of the more, S&P 500 earned 6.2%. When we kind of watered down our analysis and we picked 6 or 7 stocks using good Chicago quantum ratio or Chicago quantum score, they pretty much mirrored the market. But the ideal portfolio really blew the market away. And we're going to keep doing it. So now I'm going to take you to a pretty slide to show, and then I'm going to talk you through 1,800 stocks. It's not so bad. We're about 15 minutes into the broadcast here. Let me type up a note and let people know. Please feel free to ask me anything. AMA. Questions make the live stream better. Okay. So interesting when you go through this. So, go back to my notes. 1,800 stocks. Yeah, let's do it. So, the first thing that's important, maybe I could type up some notes so people can follow along. Hang on a second. Open up a text editor. So I'm going to make this like 36 points. So this is notes from 1,856 stocks. So the first thing is, right, we can gather all the stocks from an FTP site. And but then we have to validate them. And what we found was we had 1,869 New York Stock Exchange stocks. Okay, so at the end, we had one stock with a negative price. Had to remove it. And the problem is that we use adjusted stock prices, and this stock was negative in Yahoo Finance, but not in real life. So this is a data error, and we removed it. And that stock was HCHC. It was around negative 80 cents a share. Wouldn't want that stock in my portfolio. The other one was the covariance matrix and the Cubo were strange. They were very, very small. So that's important, right? It doesn't mean it won't work, but it's just different. This provides a different kind of energy landscape if we are using a quantum annealer. The third, building the matrix in Cubo takes a long time. Why? Well, the first is we use loops to calculate the value of every quadratic and linear value. So that is 1856 times 1856, or around 4.4 million calculations to complete one matrix. Okay, you get that, right? But then, nice. Hi, John. Good morning. That's nice. So this takes forever, right? Because we have an 1856 times 1856 times 1856, what we call the big matrix. And that takes, do the math, 1 billion, 2 billion. That's around 2 billion calculations to build the matrix. Net, it's 10 seconds times 1856, or a few hours. Too long. That's not scalable, right? Can't do that. By the way, a life hack, coffee with cacao powder. Tastes like chocolate and it's got antioxidants. It's good for you. So, keep going to the next thing. Okay, number 4. Yahoo Finance stores stock trading data. However, not every stock has data for every day. There's just anomalies. It could be the stock did not trade, or the stock data is not available. So we had stocks. We had probably, I'm going to say about 25 stocks that did not have 253 days of trading data, and 2 stocks that did not have 253 days. So what we figured out was we have to weed out all stocks with less than 253 trading days. We just have to, right? And so this takes a while. This is really hard. So, by the way, going back, it was 12 seconds a matrix, and it was 4.2 hours. That's too long. I can't do that. I got a client call me saying, Jeff, I need you to run some stocks. Oh yeah, we'll get back to you in 4 hours. Oh, that's just to build the matrix. We haven't actually done anything yet. Oh, that's terrific, Jeff. I'm going to call your competitor, right? So that was important. So the second thing we found out, we have another scale issue, right? Which is our Monte Carlo run. So normally what we do is we do 1 million random shots, and we do like 6,000 or 10,000 per size. Takes a long time. So if you run this the way we're doing the calculations. So we have different matrix calculations. Takes around 10 hours. Again, can't really have a client waiting for 10 hours. So we have to fix that one as well. So these are things like multiplication and multi-dot multiple matrix calculations where it's greater than 2 matrices. So that's something. There are some other things too. So in other words, there's a lot to do to speed it up. 1856 takes a long time right now. Our genetic algorithm took an hour the first time before adjusting the algorithm. It was a long time. Can't take an hour, right? So going through some other things here. Yep, I think that's all I wrote down. So let's get to the conclusions. We successfully ran 1,856 stocks, but it took around 15 hours to run. Actually, it took more than 15 hours to run. It took multiple validation steps on the incoming stocks, which we have now automated. Yay! 2, we have speed up the algorithms. We are at around 15 to 16 hours today. And we need to get to minutes. And that's where we are. And so we're going to report back all the different types of things that we can do. The third is that we do get what I'll call valid portfolios out of the New York Stock Exchange. This means we can suggest a few portfolios that are efficient and should be held together in an even weighting portfolio. And what that means is 10 stocks would each have 10% invested. 5 stocks, 20% invested in each. Okay, I want to thank you guys very much. Oh, where does the third dimension come from? Oh, I love it, John. Thank you. So, where does that third dimension come from? That looks like a great name of a book, The Third Dimension. So the first is that each matrix we feed to D-Wave is for one stock portfolio size. So we send it a one stock matrix, a two stock matrix, a three stock matrix, all the way to 1856 stock matrix, or N. This is because the weights are used to calculate the expected return and the variance. Different weights mean different answers. Means different CQNS score. So we go through and we would calculate, we basically have to run through every portfolio size one at a time, which is the X, Z, where X is the number of stocks, Y and Z are the stocks. Cool. Glad you got that. What else is interesting to talk about? So, I guess the thing that's interesting, the other thing that might be interesting to talk about is what are we going to do to speed things up? So, the big time sinks were loops, right? Because we're doing a loop, an 1856 times 1856 loop to build the matrix. And that just can't work, right? So we need to find a matrix way to do the calculations. We have to. So that was one. The second is when we scoring. So when you score the CQNS, right? So I have a portfolio. Okay, what's the CQNS? And that takes a while because the standard Cubo notation, right, is some vector times Q, which in our case is our covariance matrix, times the vector transposed. And so right then and there, right, that implies 3 matrices to multiply. And that implies multi-dot. Now there's a Skippy, and there's a Numpy way to do that. And for right now, they're just a little bit slow. So we have to figure out a better, more efficient way. And then lastly, once we are done on the slow iMac, right, we can send it over to the server. And we can also multi-thread. But honestly, we got to fix the code first. And that's the key. So in conclusion, right? In conclusion, here's what we got to do. We got to get to 1856 stocks. We have to clean up all of the scale bottlenecks so that we can run 1856 stocks in a few minutes, maybe an hour, maybe a half hour, do all of the speed ups. And then we're going to go to 3200 stocks, which is all of the US common stocks. that are either in the NASDAQ queue or the New York Stock Exchange. Automate the validation steps, you got it. And then we got to go back to the quantum computers, whether it's the new D-Wave, whether it's the ion traps, whether it's the gate computers, whether it's random walks. And then we got to go back to all the simulated annealers, the digital annealers, whether it's Fujitsu, whether it's really Fujitsu. And then we'll go back to Toshiba and we'll see if we can speed things up. Because with each of these new methods, we're getting a slightly different type of answer. Now, the thing that I haven't told you, this is a secret, so don't tell anyone, is that the combination of solvers actually matters as well. So, I'll answer your question, John. So the you can do certain solutions, and then you can feed those solutions to other solvers, and at the end, you can get much closer to your best answer. So that's actually a hidden secret here, is how you order your solvers. So if they each take 10 minutes, right, you can run them 10 minutes each, or you can run them 10 minutes each and then run them kind of recursively or iteratively, and then get a better answer. So the matrices are symmetric, so that should cut time in half. I would say that is already included in the models. And they still take a long time with 1,800 stocks. Good news is 64 stocks can be much faster. So, and 64 stocks is where we can do both quantum and classical models, giving clients an efficient portfolio. All right, so I think I'm wrapped up. I want to thank you guys for listening, and John, one of our researchers actually, thank you for joining. Just really great. I wanted to spend some time and share with you where we were. Truthfully, I've got a lot of passion and a lot of excitement about being able to scale our models. 64 stocks is good. 1,856 or better. 3,200 would be best. And let's push through all of the scale gaps so that we can deliver this. And then when we go back to quantum, we've raised the bar and made it really, really difficult to establish quantum advantage. And here's why. Hold on. Because Chicago Quantum creates quantum advantage. And we want to make sure that it is really, really hard to create that advantage, that the quantum computers are doing something magical, and that you as a client can make as much money as possible leveraging quantum computing to solve your most difficult challenges. So again, thank you very much for listening. Take care now.